Good morning to everybody. Thank you for being here. I'm Matteo Pisati and I hold a PhD in economics from Università della Svizzera Italiana and a Master of Science in Finance from University Bocconi with distinction. I've been working in creating quantitative strategies for asset management and for hedge funds for the last 8 years. And I have been a researcher for the Swiss Federation on the Swiss National Foundation grant for more than 3 years. After that, I have created my own firms, which is specialized in developing quantitative models for institutional investors. And I am here today to present a brief work on our report, which we are launching right now, which is intended to provide signals on a weekly basis to institutional investors in order to allow them to profit handsomely on top of the strategy which we built for asset managers. The focus of today will be on safe havens and alpha crash strategies, and let's go immediately to the point. There are three major contributions which we are providing to investors with the current work. The first is about our regime scanner. This is critical because it tells the investor if we are in a bull or in a bear market. And this is the most important information for asset managers because it makes a substantial difference in terms of how you structure your portfolio and how you can handle the risk management. Now, we will go much more into the details in the further slides of this presentation, but for now, this is the key concept. This is one of the key ingredients of the value creation which we are delivering to the investor with this work. The second part is about alpha crash strategies, which are built following the models which has been successfully implemented by Barclays Capital on some of his most performing quantitative strategies in the last 15 years. Now, some of these strategies were developed by university professors, and we eventually managed to rebuild the strategy in order to match the equity line done by Barclays with its real capital, with real money, and we managed to replicate it, and we are offering it to our clients as well. And the idea about alpha crash strategies is that basically this kind of investment style is doing its best when traditional strategies are performing poorly, and this is a huge potential of gains for investors who have the need to hedge during difficult times. The third the third contribution which we are providing with this current work is about safe haven strategies, and basically it means that we are giving to investors an allocation which is the one which has the lowest level of contagion. So the stocks which are expected to fall less than the benchmark. And precisely we are offering this service for US stocks only at the moment, but on demand we can offer it even to other portfolios. And that's the critical key points of our work. But now let's start going into more details and to see how we created this strategy and why they are reliable. The reason backing the quality of our results is, first of all, economic theory. We don't believe into a data mining approach. We think that we have to understand extremely clearly why a strategy is working, what is the rationale underpinning the strategy. And so in order to be confident that what we are doing is correct, we have to understand each details of for each year about the performance, good or poor, it we have to understand why it happened, and only when this is clear we can continue. Now, this is not enough, and we built after that a sophisticated backtesting protocol, which is based on a different lists of models, which combine provide us with extremely powerful validation tools for our strategy. So we have, I repeat, there are two different ingredients which give value to our results, and the first one is based on economics, and the second is about the statistical validation based on backtesting protocols. We move forward and we go with scanners, which is the first key ingredient of our approach. The regime scanner is probably the most valuable part of this whole presentation, and is based on the idea that the market have two key regimes, bull or bear. And the difficult part is to identify precisely in which regime we are currently in. And there is quite an academic consensus about the fact that this is critical, and avoiding high volatility regimes, you add value to investors. But how to identify this regime? That's the most difficult part. We tried tons of models, and the one which providing us with best results is about the one which creates identifies the regime through options, and precisely disentangling the option volatility into components. The first one is about long-term volatility and is converging toward its historical mean in a slow fashion. The second one, or short-term volatility, and this one is extremely fast into converging to the mean after the initial shock. So the two things spike together when something's negative happens, which hit the markets, but they converge toward its long-term means in a different fashion. These create the signal. When the two lines are crossing, one from long-term and the other with short-term volatility, the signal to re-enter into the market is hit. And this creates us with an extremely powerful signal, which is valuable for the long term. Long term means that a regime lasts for more than a year on average basis. So once you enter into a regime, if nothing crazy happens, it will last for a long time. And that's exactly what investors are searching for. Asset managers don't want to rebalance their portfolio too often, and they want to stay invested for taking the long-term trends. And this is exactly what we are help them achieving with this model. If we look at the rationale which is underpinning this approach, is of course based on the interaction of 2 points. The first one is about the behavioral dynamics of financial markets, because as we know, human sentiments, human emotion play a role which can be extremely significant. And why this is so important for our model? Well, you can think in this way. When you see a car crash, okay, you scare, and for some time you will drive in a much more prudent way. After that you will start to forget, and you will restart with usual behavior. And that's exactly what this model is trying to capture. When the investors have been hit, and so they are over cautious, so they are too much prudent, and this is a big investment opportunity because the risk is gone while the expected return is at its maximum. And that's the first ingredient of the rationale underpinning the strategy. The second ingredient is about the market microstructure. Market microstructure is the logic of the book of orders and how this is linked with the subsequent financial market returns. Now, I wanted to provide with the clients not just with a number, but with a visual representation of the strategy. This is a little bit shorter term, but it provides with investor with a visualization about where we are. Dark purple means that we are in a bear market, while light dark colors will tell you that we are in a bull one, with the yellow being in a situation of overbought, which is indicative that a significant correction may occur soon. Let's continue with the analysis of the results which we are providing on weekly basis. First thing, the most important number is in this column, and precisely the last line of this column, which provides to the investor the current long-term regime. -1 in this case means that at the 28th of April the model was still bearish, and the other significant signal which we are providing is the short-term trend. As you can see, in April this was positive, and this indicates that for an investor which has short-term horizon, it was meaningful to be long during these weeks. And this is exactly what we have seen, that the results were overall positive. Now, let's go more into details. What is the value which we are delivering through following the signals? And as you can see here, we have plotted two equity lines. The first one is coming from the cumulated return of the S&P 500, which is the most famous US equity index, and the blue line is the results of our strategies, which follows the long-term signals. Okay, and as you can see, until the first of all, the equity line is much higher, and the second thing is that basically the market drawdown of our strategy is just 18%, which is half of what is the index itself. And more interesting, the average return is 14%, which is more than twice the index return. And so this means that basically we are doubling the returns while we're reducing the risk of a drawdown, which is an excellent job. We are now trading this strategy with with real money, and the results are extremely positive. So we are very confident that what we are doing is correct. But let's continue with the second strategy which we are giving to investor with this work. And I am talking about the Alpha Crash strategies. They are coming from Barclays, and precisely from the works which were developed by Professor Campbell and by the very famous hedge fund management Fitznagel. And the two books, one is called Safe Havens, and the other one which is called Strategic Risk Management, which are at the base of this work. So they provided the input on top of which we built our models. So first of all, what we have observed is that a correct implementation of the strategies delivers extremely positive returns of more than 14% per year, which is mostly generated during market crashes. So they're doing the best, while the equity and the fixed income markets are doing the worst. And even more importantly, uh, more than 80% of the years the strategy are positive. So they're not just doing good job during bear market bear markets, but they are doing a very good job overall. And which is still economic rational, which is underpinning the performance of these strategies. And basically is the interaction of two very powerful signals. One is based on momentum and the other is about cyclicality. Cyclicality is critical mostly for some asset classes like commodities. You can think that's pretty obvious. For example, the price of gas rises each winter and it goes down during the summer where the demand is much lower. This makes a lot of sense from an economic point of view and is englobated in our model in order to provide a higher return. Now, here we have plotted the equity lines of the strategies. One is the application of the strategy on equities, one on forex, and the third one on commodities. And finally, the green line is the average of the three. Here we have the performance of the average of the three strategies, so the combined strategy, let's say, and basically you observe an average yearly return of 13% with an annualized Sharpe ratio of more than 1. The drawdown is around 20%, which is not extremely high because, as you know, equity indexes have a drawdown of around 40-50%, and in commodities this is even higher. So the results of the strategy is pretty robust. Now, we deliver additional ingredients to investors in order to help them manage their portfolio. And one of them is the study of the diversification, how to achieve a higher level of diversification for their portfolios. And in order to deliver this information, we focus on two things. The first one is about the long-term correlation during bear markets, and the second one is about the short-term correlation and its dynamics. And we found a way to plot them in an intuitive and easy to understand way. For example, this is the correlation matrix of a large pool of equity indexes which has a global span during bear markets. And what it means is that we take as bear markets the daily returns which are negative for the S&P 500. So we use S&P 500 as the reference point. And then we see the behavior of the other indexes in the same days, and here you see the output. As you can see, dark color means low correlation, which is exactly what we are trying to achieve, while light colors implies a high level of correlation. The most interesting results here is to see how the Chinese indexes are the one who have the lowest correlation with S&P 500s, while other indexes like the Marvel have a significantly low correlation as well. So this is the first, striking results which are useful for investors. So it means basically if you hold US equities and you want to diversify the risk, you have to search for Chinese equities. That's bottom line of this table. But if you look into details, there is much more value here. Now, this is the second table. And here I am focusing on the forex markets and currency pairs. And this is telling us about the short-term correlation dynamics and how we can group forex pairs into clusters which are nested one into the others. So how can we read this graph? First things first, the closer is the matching to the bottom line and closer is the dynamics of the forex currency pairs, and higher it is and more different is their behavior. So as you can see, there are two major blocks, one which is on the left and one on the right of these tables, and so the correlation between them is lowest among these two blocks of securities, which are the main clusters of this analysis. And then you can see shorter lower level clusters which go lower and lower, and it ends up with the pair which have the highest degree of correlation. In this case, euro dollar and euro Turkish lira, which apparently have extremely high correlation in the last 3 months. So we are looking specifically, and that's critical, to the last 3 months of data for this analysis, because here is looking at short-term correlation, while in the previous graph we were looking at long-term ones. So that's important for understanding precisely what we are doing. Now let's go to the last part of this presentation, which focus on safe haven. These are extremely important during financial storms. You may think, why, if you have alpha crash strategy, you need safe havens? Well, that's the reason is that the alpha crash strategy are based on leverage position, which can be both long and short. Not all investors can have a short position or can use leverage, and because of that we develop a strategy which is long only and is on equities and does not require any leverage, so is open for all traditional mutual funds with equity position, so no leverage and long only positions. Now what we deliver is a strategy which is based on contagion, and contagion is much more effective in providing high quality results than a strategy purely based on beta. So traditionally what investors do when they know that they are in a bear market is to look at low beta stocks. We have created a more powerful approach which is based on the logic of contagion. Contagion is positive during bullish markets because the market is rising, and so you want to see the kind of security which have a more aggressive behavior, and so the one which have a higher level of contagion. While exactly the opposite applies during bear markets when you want to have low contagion stocks. Now, what we are providing is a list on weekly basis, a list of stock on the S&P 500 and on the Nasdaq 100 which have the lowest level of contagion, and that's important during bear market only. And I repeat, bear market only. During bullish markets this stuff is not so useful and you shouldn't implement it during bull markets. Now this is powerful thing because it minimizes your losses if implemented properly, and implemented properly means that you need to rebalance on a weekly basis, and you have a significant advantage which we have plotted here. If you look, for example, at the Nasdaq 100 weekly, so the implementation of this strategy on Nasdaq weekly, you see that you can have an average yearly return of more than 25 per year, and this is after transaction costs, which we have estimated carefully for a portfolio of 200 million. So you have a higher amount of money to invest. We are more than happy to provide you not only with the signal, but even with our execution strategy, which can handle up to 4 billions. Now, the price of our services. We are not charging million euros because this would be the profit you can make following these strategies in a precise manner, but we provide two different services, one which is standardized and is for 15,000 euros per year plus VAT, and the second one is about the customized version of our service where we deliver everything, including the execution, the risk management, and the calibration of our models to your specific needs, and this is done for the price of 40,000 per year. Now, because we add tons of value and we have a team which is composed by university professors and PhD graduate, this price is not so high. If you think that our target client is a huge institutional investor with more than $1 billion of assets under management, it's not so high. So thank you for the attention, and please make me all the questions you consider important in order to understand this product better. Have a good day and thank you for the attention.